Yes, this works.
Okay. So you're recording, right?
Yes, yes.
Okay, nice. So just a quick overview. This is GU from Friday, so from yesterday, basically. Just um, marked some stuff up, just looked for myself and I discovered something really cool. So like you see, if I give you the value in here, like the GB 10-year minus the US 10-year, right? You see that if I have to go back now. If I come here, the curve is starting to gap, right? Doesn't make any lower low from this point from 9 o'clock, right? This is the London Open basically. So what you see is a slow accumulation into the lows. Like for example, imagine prices dropping. Let's say they're not buying it here because there is no real value, right? So this trade is left off and this one too. This one basically too, but value, no, actually value starts from here because it doesn't make any lower low, right? So you see, this is where the curve is kind of flat. It starts to go in the upwards direction.
Okay.
So it's not making any lower low here at this point. So let's say they started to accumulate some buying. Just have to switch the arrow in a different color here. So what they will do is actually buy a little bit of the price action because they think, okay, value is at the bottom, so we can start to buy. When price comes down, they see value is still up. So what they will do is they will buy, for example, a little bit more. Let's say, for example, they want to have 200 lots on the whole trade.
Okay.
What they will do is they will put like maybe a 10 lot here, right? Then they will increase their lots here for like, let's say 30 lots, okay? Because price is now lower and value is higher. So they try to accumulate more size into lower prices. And at this point here, right here, wait, if I give you this low here, this is where they probably, because of the volume, if you see the volume here, right? You see in this whole move here, they probably, I don't know, let's say they put 10, 30, let's say they put 80 here. So effectively we have now like, what is it, 120. We have 120 here and then you see prices dropping again. So what they will do is, let's say they will put 50 lots in here now because you see prices declining. Actually, it was declining on the higher time frame, but we just mark out these levels, right? Because value is higher. You can see that I have to
Okay.
go back. You see that value is kicking to the upside at this point, right? So these are all buying opportunities at this point. If we just think about it, let's say they bought 10, 30, 80, 50, or maybe here, like again, 30s and 10s, right? It's still enough to move price of values to the upside because no institution will sell in this whole accumulation phase. Just retailers basically will sell in accumulation phases because they don't know what's really going on. They see, okay, price is making lower lows, but they don't understand why they make lower lows. And we know why price is actually stopping. I have to delete this because, oh man, okay, because you see we have this liquidity level here. We have, if I put the VPS on, we have here a high volume zone. Basically, this is the high volume zone actually. But if you just take, you see how the volume gets thinner once we come below the POC of the previous day. So this is something we want to actually notice. I'm just gonna draw out a straight line, but you see, this is the highest point, right? And below
Yes.
this point, volume is constantly decreasing. So this means if there is less volume here, they will probably just not come below this low here because there is no liquidity below this low here actually. So the most liquidity is here at this point, and right below this point there is this low here. So there are a lot of buyers sitting, which they actually took out here. So I would just put this here off because you can see this is a B shape, right?
Yes.
In the overall picture from this day, but this is this day. So what they will do is they will reaccumulate. It's not like, of course, they're stopping out these buyers here, but also they bought in here. So what they will do is actually, once price comes back, they will start to buy again, because this is all where they previously had their orders in, you know. So it's actually a reaccumulation. So they reaccumulate. They accumulated here because value was something higher, at least a little bit, you know. So price came up, price came down, and then the same zone again, value started to kick to the upside. So they knew, okay, when we come into the zone, into this red level here, this red level, I will just mark it out like a little bit stronger so we can see. Now I have to delete all this stuff here, all this stuff here. Bias auction, all these arrows need to get deleted. So, oh no, the level needs to stay on. Oh man, okay. What am I doing? Hold on. Come on. Yes, exit. Okay, I need to just delete all these arrows now. I just need to clean it up so it gets a little bit clearer. And all these arrows, bars, whatever. So you see, once we hit this level here, you see how we hold it, right? You see there is something going on, and if you check on the 5 minute, you can actually see this is lower, right?
Yes.
But we're not breaking the slow here, so this becomes like C liquidity. This becomes C. Hold on, bottom left. This is the C, and this is the paycheck now. Bottom left. I have to. And also time of day is important, because from 9 o'clock, you see the highest volume is coming in on this candle here, right? It creates this liquidity point, it trades back up, value is already to the upside, then it comes down and it doesn't take out this C liquidity, which makes it paycheck now. So we're still trading lower, and then we get this withdrawal of liquidity candle. This is a big, large candle, and look what happens. We take out paycheck, we take out this big liquidity level here, this actually it's this liquidity here from previous day, right, into a reaccumulation zone, this red line and this red box. Basically, let's make it red so we understand it. And I will just delete these two lines now, and now what you see is basically, you can see the auction, right? You see that the volume is not higher than previous, and that it's declining into this candle here, so this makes it a bias auction, right? So we can start to buy this, or let's say we don't buy this here, right? We buy the 50 pullbacks now. So I would delete everything, because we now know, okay, this is the withdrawal of liquidity candle. We have value in our favor. This candle here, right, is a big bar. So let's say we take the range from swing low to swing high here. Let's say we just take the body of the candle on a 1 minute chart eventually, because now we can really go into the microstructure of the trade and just breaking it down, you know, like from this point, now, okay, this is buying, we know where do we buy actually. So what I did was I took the last candle here, because you see it has no pins. You see it, like just straight bar, no pins, nothing. So I took 50% of this bar here, and you see where it pins, right? The 50%.
Yes.
If we go down on a just for the purpose, I will go down to the 15-second chart now, just to show you that price is in fact very fractal. I hope I can go back that far. Yeah, I can. So we have this type of balance area. Actually, we could take it like this here. Like this would be our 15-second balance area, okay? Swing high, swing low, we trade it up. What happens? We reject it, and you see how price is constantly getting higher and higher, right?
Yes.
These are just from this perspective here. This is all your confirmation that this is a higher hold now, and now this is not only without the 25s, but now you actually see the BSG trades on a 15-second. For example, you know, you see how the value is switching from 1 to 0 to 75 to 50s, and then to 25s actually, and then it just goes. And if you, for example, would have taken this projection with a -2, the -2 level would be approximately here. And this is okay. We don't have to look at this measure because it's not very useful. Gonna be honest, because you would never look at the 15-second chart, you know. It just it's just too much noise. It's too much stress, but you see that it actually works, right? And if you go just back to the 1-minute chart, you can actually start to identify these type of holds, because you can just take the same balance area from swing high, swing low, swing high, swing low on a 1-minute chart, and you see it a little bit better. So here, this 50 bounces here. Once you see this little, I would say order block forming, right? This, like this here. And if you see it makes a swing low into it and rejects it, and yeah, it's just destined to go higher. You know, you have the bias because look at the value. I just have to show you the value to, if I would ask you on a 1-minute chart here, wait, I have to go back again. What is the trade, right? What is the trade in here? What would you say? Would you say it's a sell trade?
No, why?
You would no way say it's a sell trade, because look at the value. Look how high it is, right? And look what happens. This is the best part here. This is really the best part. I have to take this here off. I take the swing low to the previous swing high, right? I have this measured move at the top, right? You see that?
Yes.
Look what happens. Boom. We pin it perfectly. Look what happens. This is NFP. Boom. It pins it. It comes back on low volume, right? This is now lower volume than previously. What we can do, boom, low volume retest. We go down. We come back up. We test the previous supply zone. Supply zone, and boom, we go. Then we get the London fixed level, which is the 17 o'clock open. Basically, this is the simplest trade. Like I took 2 trades yesterday just of this. You see, this is the 17 o'clock bar, right?
Yeah.
I mark out the open. Look how the open reacts on a 1 minute. You see it? Boom. It trades higher. It fails to make a successful auction based on this balance area. If you take the swing high and the swing low, now look what happens. We come down from here, we test this level one more time, we break below it, and look what it says here. London fixed level, buy side above, sell side below. So once it goes below it, now it is the 50 and the zone, and look how perfect it trades, right? Look, boom, and it hits the full measure. Let's say you would take a 1-to-1 trade. It would be enough. Like if you put your short trade here, previous swing high, previous swing low, a 2-to-1 trade. It's 20 pips, you know, it's 20 pips. You have a 10 pip stop loss, you have a 20 pip target. Boom, this is your trade outcome. From 17 o'clock to 18:30, 1.5 hour, 20 pips. No heat, look, no heat. Boom, down, up, down, the trade is finished. Crazy, right?
Yes.
But this
What
is the most
London fixed level? How you decide this?
17 o'clock my time. So it is 16 o'clock, basically London time. It's what ICT teaches is the London close. But there is a fixed level, like this is a fixed rate where the prices for the bonds are getting fixed. So it has some importance, and I will show you right now. Wait, I will have to give up my whole screen now, because where is it? I have to, yeah. Okay. So you see my whole screen now. Now I can go to, hold on, I need to drag this up here. Like, look at the Euro USD, okay? I just marked out all these red levels, right? These are the London fix zones. Look at this London fix, for example, right? This is just 17 o'clock marked out in time, okay? Look what happens.
Yeah.
It's just a zone. It's just a zone. It's nothing special. Just a zone, a fixed level, which gets targeted. And like GBP USD, same shit. Look, I don't like to say same shit, but it is really the same shit, you know, like where was the trade I took? Yeah, I took sell trades. Basically, this was the London fixed level. This was from previous day. Once this pinned here, like I actually already entered in here, right? Or in here, this was my entry. I entered here and look, the price went for a whole 30 pips. Look, 30 pips. And then it comes back here, retests this level exactly to the pit. There is no order block, nothing, because there is an order block, but the order block came after the level. So first the level, then the order block. Like, look, do you see it? You would classify this as an order block, right?
Yes.
But look, I knew this level would have significance before the order block even got created. Like, look, I just marked this out here, 17 o'clock onwards. Boom, trades in here once, right? And this is where I traded the squeeze trade, because I saw, okay, price is bouncing up from here and bouncing again. This is a bad sign. So what I did is I took the 50, right? And I traded the squeeze trade above the 50, basically. I just bought this low here at this order block here, basically. This is what I did. I bought this retest of the order block, this hold of this order block. Why? Because it was above the 50. And I just traded it for what? For 8 pips, right? I traded it for 8 pips. I collapsed the whole trade and went instantly short. I went instantly short because the value was just down at this point. But I knew, okay, this is the institutional trade. They will fade the top edge, you know? They will fade it. And once you get this pin rejection, it's a no-brainer. And then I looked at it, I said, okay, this trade is good, swing high, swing low, 50 bounce, bam, bam. It creates down, it trades up back again. I failed to move break even, so I just had my stop where it previously was. I don't know how big my stop is, but I just held the trade on, and look, it went for like a big amount, you know, like it was crazy. So look, this is look at this is a 1 minute chart, right? But we analyze from a 1 minute chart and look what kind of moves we get, right? It's like almost scary. Like, for example, if I would turn on this balance area now, if I would just turn it up, right? If I would say this swing low, swing high, I make my projections to the downside. I won't look to the right chart now. I would just mark out the levels. I would take profit here and here and maybe in between here. So 3 levels for profit, okay? I won't count these, but one of these 3 levels will get hit either way. And look what happens. We go. This is still from the previous day. Boom. You have your level. Look at this level. Look at this level.
Exactly.
And look at this. It's not hitting it, okay? But remember, it's a zone. It's a zone, right? And look at the
Yes.
response. Look at the response. Just beautiful. You cannot make this up, you know? Like, what I did was basically I took this balance area which I made my buy trade. I just turned it. Look, if I put it like this is a right hand higher hold, right? It's holding in the right hand. So it gives the squeeze trade. This is the squeeze trade. And then, but you know the value is down. So you actually, if you see this rejection, not acceptance, you just turn it down and sell it again, and you keep the level on basically. Then you get this level here, and it's just boom, and you know where to exit, you know where to enter, because the algos are entering in here. And look at the time. The time is again important, because we again have like from 9 o'clock onwards, from 9. This is what we just marked up, right? From 9 to 10, 1 hour. You got 1 hour to exit the trade in here, because price is really slow when you start to accumulate buys. And this is where the algo is starting to hunt, right? And boom, look what happens. Price instantly goes to another measure move, man. Like, I can't make it up, but it is what it is. It's ridiculous. It's ridiculous.
So
It's so clean.
how to define that upside measured move on that balance area?
On the balance area down, you mean? Like on this
I
here.
mean, yes. How to define this upside?
Look, we had this, where is it? We have, you have to always be a little bit flexible, but in my opinion, this would be from the London Open, basically from here. I would take it from here, because from this point, price is getting slow. So you can either do it like this, right, which would give you the measured move. Or you can take the whole area basically, like this here, because you see there is a 50 bounce coming in at this point here, like here and above here. This makes it a right-hand higher hold, right? So
Yes.
this area here is a right-hand higher hold, and you would buy the down candle in this right-hand higher hold with value down, and you wouldn't have any heat. You would only have this heat here. This would be your heat, 1.8 pips. And look, it goes for one measure. It bounces back. It comes for the two measure. Then the trade is finished. You exit your position this high. You go short at this high. You capture this down move, 20 pips. Boom. Or this here. Boom. This is also 20 pips. If you exit here, enter here, this is even more. This is 40 pips. This is crazy. This is nuts, man. Like you just measured moves, right? Just measured moves. You get 70 pips in one day, then you get the high, you get 40 pips, you got 100 pips in approximately 7 hours, which on the one lot is how much? $1,000.
Now
the
they
one
are
lot.
again accumulating the high volume.
Yeah, and now they're accumulating the high again. And basically you just have to look at value, of course. Value is always king. So, okay, this was now just the breakdown. We spent 20 minutes on a breakdown of GU, but I just wanted to show you that structure is really king with value together. So we take a look at the Indian 10-year, US 10-year supply demand, except the highest. What do you mean by except the highest?
I mean, there are more high
Okay.
spike.
Okay, withdrawal of liquidity versus stopping volume, scaling of yield, tight stop. Okay. Let's start with a fresh chart template. Displays TMA. Okay, so I don't want to delete anything here, but I will just open up the Bank Nifty because I have nothing in here, and I will delete the CMA. So we have a blank chart. So first, what we of course do is always
Siva is up 7%.
what? It's up 7%.
Siva,
Really? Oh,
look at
Shiba Inu, you mean? Yeah. A friend of mine bought it, right? And yeah, this man, I feel sorry for you, man. This is mad shit. But you see also this high volume candle, right? This is an exit for institutions, basically. So this would be your exit candle. Because you know something will go on. Maybe there's this order block here, I don't know. I'm not a crypto expert. I mean, I bought some cryptos. I can show you which one I recently bought. These are on my list right now. Mina, it's something very new. And to be honest, the price action on this is really mad, but it's approximately at the 50 and it's a fairly new project, right? I have some levels here and I bought at $4 if I'm not mistaken. So currently I'm up like, what? I'm maybe up like only 20% or something. Yeah, 20%. It's not big. And I bought Matic. Matic, which was actually very good on this dip here on 6th October, currently doing actually good, also 15%. It's not much, but I'm hoping that I can hold it for a longer period of time, because with these I will just show you something, because I think I still have it somewhere in here. Maybe I've deleted it, I don't know, but I show you something which is just brilliant, you know. It's in my paper bag probably because it's so brilliant. Look, Luna, yeah, Luna Daily. Look what I basically marked up, right? This is the -1 measure from swing high to swing low, right? I've used this fair value gap here and I bought around 577, right? You want to know what price is now?
577. Okay.
Yeah, look, this is, I did nothing on the chart. I did.
This is still on, or you exit?
What?
You exit from Luna, or this is you are
Yeah,
still in?
you got your entry, you got your exit. You know where the exit is because price hit -1 perfectly. It rejected, right? I'm honest, I exited here at 35. Okay, I'm kind of mad because I could have held for like 60% more, but you can't be mad if you entered at 4 or at 577 somewhere in here. Like let's do 6.
It's
Let's do
like 10 times.
this is like 6x, right? 6 times, approximately 5 to 6 times. This is good, you know, and it works, man. You see that it works because it is the same chart, right? The
Yes.
levels are the same. I mean, I've changed nothing, not the bar, not I even did the projection to the upside. If I would show this to somebody, he would say, how the fuck are you doing this, right? But it's just algorithmic. So I'm expecting the same to happen here, like to see some upside potential, at least -1, -2, which is a good fair amount of money, right? 200%. Like Matic, for example, this has even more potential. This says like, this is where I marked price up, like at $8, for example, maybe 10, just to make things a little bit smooth, right? But I'd be happy with $8, man. I would close my position and get out with like 500%. You know, it's people
Yes.
are always aiming for these 100x moves and some type of stuff, but how often do you get that, right? This is also something I marked up. This is really crazy because I bought here at this line here, and this was a supply line, right? A demand level, a supply level, and I exited actually right on this move. So I just took like 100% out. It came down, it shoot it all the way back up, and now it's holding. And I'm kind of mad because I just should have held that, you know. But
After
that's
this,
my problem. I can't hold the trades for too long. I'm a scalper, and so this makes me like if I see this rejection, right? I'm scared. I'm like, oh man, this is gonna back go all the way to my entry, and it did, and then it went up again, right? So this is really mind game.
holding is very
Holding is
tough.
hard. Yeah, it's hard, man. But in crypto, you have to get used to it. You just have to have the balls for it. All right. So let's look at it. Let's look at the US tens minus the EN tens. Let's get it. Let's get it. So what I do is how to scale it, right? Pin to scale, no scale, full screen. You know that.
Okay. Into scale. Yeah, okay.
Then you go to the right bar here and click on regular. So it shows you in percentage and price. So just by looking at this, I would say this looks pretty similar. But if you compare it with, for example, the EN10s and the EN2s, right? Then this looks a little bit messier, but this looks only messy because of the EN2s, right? This looks messy because of the EN2s. So for example, what you can do is take the EN30s and the EN5s, for example, because this is the same. This is the front end of the curve, and this is the back end of the curve. So the longer term yield, right? And the longer you hold your yield, the more percentage you get out of it. Because what you basically do when you buy yields is you buy debt. So this is a long maturity debt and this is a short maturity debt. So this is the front end, this is the back end. So if you take this, for example, you see this curve should be a little bit smoother. It's not picture perfect, I have to agree, but this is on a 15-minute chart. And if we look on a 1-minute chart, for example, this looks total crap. I have to be honest, this looks not tradable at all. Okay, let's switch back to the EN10s and the EN2s. But what you can do is actually smooth it out. Let's see, maybe. Yeah, you see these lines here, if I get value on, they're almost the same. The EN2s are just hell, they're just really, oh my god, it's so unpredictable. Because for example, if I show you the US 10s and the EN2, the US 2s, right? Look at this curve. Wait, pin to scale. If I just remove the chart here and I remove this here, and I just take, like, for example, gold, right? And do you see what's clean and what's not so clean? Like, you see the US curve moves a little bit better than the Indians, because the Indians are opening at 5:30, right? And it's closing at, it's not closing, but for example, if we take this move here, right? If we just analyze this move here, this was a rise in the Indian tens, right? So the Indian tens, imagine this is the Indian tens, right? This is the Indian twos. If this rises and this stays flat, this is a steepener, and therefore you would buy the steepener at this present time. So if we go back to the Nifty and just look at this time, 780, right? We would look for buys on C liquidity from 780 onwards, okay?
Okay.
At this present time, okay? Let's just say, and now we put the chart on, and you see there is a little bit of C liquidity, but like, for example, you would bought the C liquidity here. It would be, actually, you can't buy the C liquidity anymore, because look what happens. Price opened with a gap up here, right? It opened up, so this is just, how can I say? It's just a adjustment, okay? It's just an adjustment because the curve was flat here. So when the gap opens, you can try to sell it, but it's just not really, how can I say?
I
It's
buy
not
here
clean. It's not clear. You have to use other measures just to see what is going on, because in the sum total, if you take this volume here, right, from the open down to, let's say, to this low here, to this big large candle, yeah, we take out C liquidity, and this is a buyer's auction, right? So you would look at this bar and say, wait, I just have to use a couple more indicators. I need Bill Williams fractals. Oh, no, don't need who. I just need the normal fractals. Like, for example, you see, we take out paycheck basically on lower volume, and it has some high volume in it, but you would have to go to the 1 minute now. Now we have to go back all the way to this price action and just look what actually happens, right? So we have this high volume bar here, and we trade back up in the range. So what you can do is you mark out this balance area, this sum total of balance area, because this is not acceptance, this is a rejection, right?
Yes.
So you would take this balance area and just identify, okay, where is the 50 hold? The 50 hold is here. Value is not doing anything good right now. So maybe if let's say I take the Indian tens and twos, and I need to take the risk line as well. I need to incorporate the risk line.
I buy this low because of this risk line.
You bought that low?
Yes.
Oh, okay, that's good. You see, this is where you have to be, trading is really, how can I say? It's, for example, if we take the risk line at this present moment, right? Do you see value making any lower low from this open, right? You see, wait, I just have to, if I go down in price, like when this drops, right? When I take the Indians off and I just take the risk line, I would just like to have it a little bit smoother. It's a 1 minute. I need to I will use the 5 minute because it's just pure cancer, man. Like, but you see, actually, price dropped here, right?
What I
But
observed that
when this dropped here, this was making a higher high actually. So you knew, okay, this is my discount. This needs to be my discount. And once it rejects back inside the range, you can buy the close of the bar. Not, you don't have to take the low. You can buy the close of the bar and just put your stop below this low here actually. If you have value in your favor, because what you do have is from this point here to this point, this is making a higher high, right? This is making a lower low. So you know, okay, I can try at least to get my fingers on this trade. And if you're not confident enough, you wait for the 50 bounce, which of course happens here, right? You see that. And then you see big volume into a big up bar, which is of course liquidity here from this day here. So you would use a part of your exit, but let's say you take this swing low and this swing high, right? Your -1 projection is at the 0.75 and you would exit the trade somewhere around here and somewhere around here -0.5, somewhere in between here. Just for a measure, if you would bought this, right? If you bought this low here, for example, or this here, this hold, then you would try to hold for at least the other side of liquidity, because what effectively will happen if there is no acceptance below this price, right? If it comes back, then it needs to test the other side of liquidity to see if that liquidity is real. And in fact, this liquidity was real, because if there is no buying in here, right? No selling in here, if people are not willing to sell below this price,
Yes.
why would the market maker go all the way down here for what reason? They would just reverse price of it and take the other side of liquidity. So effectively what you have is a balance area with a 50, which holds and then goes to the other side of liquidity. And what happens here is the institutional trade, basically, because now we're starting to accumulate something. You see? Now this becomes some type of accumulation and a P shape. If I, for example, take indicators and I use the session volume. Now, where's the session volume? Yeah, here, there it is. This becomes on a higher time frame a sort of P shape, basically here at this price point. Overall, in the whole picture, if I take the 15-minute, I just have to use a higher time frame. Like from this swing low, this swing high here. Wait, I have to use a different indicator. The fixed range I need to take.
Yesterday I shorted the market at here. How we can say? If you,
what did you say?
Yesterday,
Yeah.
what I thought that market taken the paycheck and short from there. You can see here around 11 o'clock in your time. The last red.
You mean this
red
200?
long candle. Yeah, the last red long candle. Last red long candle.
Yeah, this here.
No, after. Here
After
when
this one.
goes up here when see from the last line.
Okay, wait.
The last.
Can I somehow how can I say? Can I give you permission to draw? Is it possible? Wait, I will try.
This is possible, but I don't know how it is.
I just have to. Maybe it works. No, actually no, but I saw that some
price is 37,960. 37,960.
37,960 here.
Yes, I shorted
okay. Okay, you shorted it here. Okay.
Yes. So I thought that there is a market building liquidity upside that point and some sort of paycheck liquidity. So when it will grab, then it will fall because lots of liquidity below side.
Yeah, right. Because you see, this is all paycheck. This is building up now, and you see a big up close into this bar actually. And if you, let's say we look, this was yesterday. The risk line was basically, it wasn't up, but it spiked. It wasn't making any lower low here, any higher high from this point here. So you would just be inclined to actually, yeah, definitely. I mean, if you would look at it from a tick chart, right? If you would just say you go bar by bar like this, and then you see this here. This here must give you some clues, because what you see is, okay, we're close to this low here. Boom, we crack down, right? So gold is strong, risk off. You have to think about it like this. If this line here goes down, gold is going up, right?
Yes.
And the ES market is actually going down. So when the ES is going down, that means all stock markets need to go down. It's just common sense, right?
Okay.
Because this is risk. This is a risk on market. Now this is a risk on market. So when a risk on market drops and a risk of market drives, this means this curve here is going down, right? And if this line is going up, the ES, if the risk on is going up, this means gold should go down. This is the curve. This is the risk curve basically, because this is how you spot risk. And now if you see, for example, bar by, we have to take bar by bar analysis, of course. Now you see this curve is dropping, right? So gold is getting stronger and they push price into liquidity, right? And a round figure, which is almost like, I would say, like this level here, it held below it, right? So there is some, yeah, it is a definitely opportunity to short, because you can see this price here crack down already from this high. So once this goes up, you can short it, and it was a nice trade, not gonna lie. Because on the 1 minute chart, you would probably see some indication. High volume candle,
Yes.
just a withdrawal of liquidity. Like if you see, like I said, you like big bars. If you see big bars, you like to enter and exit on them, because
Yes.
if you
Why
see
I,
this,
I can't say that this is stopping volume? Why this is WL?
yeah, right. Because look, stopping volume is this can be withdrawal of liquidity at the same time, right? Because you must think somebody must have gone short at this close here and massively, because you see price is just driving up, right? But it's driving up for no reason. What is the actual reason for price to drive up? Like if you just check the value, there is no real value. And if you look at the risk line is not suggesting that anything could justify this move, right? So this must be just a liquidity run. This must run liquidity on high volume. Somebody used all these stops here to exit their positions and go short. And the same thing you do at the bottom edge, because if you see fast moves, you want to exit these fast moves because these are called gift bars. Like if you see this, you say, wow, okay, this is a nice bar, because compared to these candles here, this is like what, 3 times the size, like once, twice, and approximately 3 times the size of the bar, right? If we just take it like like mentally, you would say, why did this bar happen and does it make sense? Especially in your market, because your market has really low liquidity. So
Yes.
what you actually can see is also now, yeah, we have paycheck.
What I was watching that if you see the 5 minute volume from the high side, you see the testing of the volume. See, it's from the high,
This here,
for,
from this high.
yes. Then I
From
draw
this,
the line. Yes. So there is a volume, high volume. So what I think that they will be test this volume. So I will wait for the high volume candle. I
yeah,
draw
like,
the volume declining line on the volume chart.
okay. So you just draw like the auction
Yes.
type, you mean the auction.
Yes. I draw this and I was like waiting for some this liquidity grab on high volume. So I thought that I can short this.
Yeah, I mean, you already had your markup, right? You had like swing high and swing low, right? This is
Yes.
swing high, swing low. And then if you look, we're not at the 50, okay? Like it depends how you mark out your balance area. If you take your balance area from this swing low to this swing high, then you definitely get your 50 area almost spot on, almost not perfectly, but it always depends, right? So what I would say is you have to take a look at the whole market. Like this is Friday, Thursday, Wednesday, Tuesday, Monday, Friday, right?
Yes.
So all this together is actually just a higher hold, right? You would agree
Yes.
that from the swing high to the swing low is a higher hold. And for example, if you take now this swing high, this swing low, right? You get approximately some type of measured move. This is like always the sense. It doesn't matter how you turn it, you will always get one of these type of levels here. And what you can do is you can start to incorporate smaller balance areas in your price in your trades basically. So you see this is a -1. Let's say your bias is short. You mark out this level here and you say, okay, this is where I want to go short. It comes back, it comes up higher, see liquidity grab, boom, take it down, right? And you just mark out price from range to range. Like for example, let's say this is the bigger balance area, okay? You want to be a buyer of the 50. It depends if the risk is on, right? If the risk is on, you want to be a buyer at the 50. And if risk is off, you want to sell the premiums, so the higher highs. Like this, for example, this was a rejection, right? This was no acceptance. This was a rejection, basically. So what you can look in these type of zones, like for example, like I think this year we marked this out. We marked out this like this open on this candle here, this high volume open at the 50. They traded here the whole day, and then they accumulated enough size and just went north, right? And then when it comes back, you know, okay, it is still the same zone approximately, not perfectly, but approximately the same zone, right? So you can be inclined to buy because it's at the close, right? And at the close, you can try and look, okay, what are they doing into the close? Oh man, this line is really trash.
Actually, what
Like,
happened, what I see that in option chart, I see that there is a high call, 38,000 call ratings are there. So I
here,
think that
at this
on
point,
Thursday, yes, on Thursday, what they do with gap up like this, that they want to clear that call writers of 38,000,
yeah, this makes
38,000.
perfect sense actually, because what I didn't do is I wasn't looking at the bank nifty uh, call call options or open interest it's called. This is what
Actually,
we
that
once did. We did that once, I think, and the trade worked out really well from that level, I think. Nifty trader Indian. So
that was
this,
Thursday expiry on my market
yeah,
on
like
that
you
day.
said,
Yes,
like
gap
here call options 38,000, like
on that
38,000. Like I will
okay,
just select everything. 38,000. Just mark it. So from a higher time frame, you see actually this is a key level, obviously, for big banks, right? So let's say above this level, you only want to short, right? And then you need to have another level, which is this here, the puts, right? These are the calls. The calls are actually the buyers, the hedgers, right? And puts are short. So you look, for example, there is no increase in price, increase in open interest, indication of new money coming in, indication continuation of there's just price change, but this is most likely not true actually, because increase in price, decrease in open interest, increase in price is due to short covering of positions. Increase in price, decrease. I don't know. And I just know what to look for with on the money calls and on the money in the money and off the money, I think it's called. But either way, what we need is these levels. We need the high volume levels, right? Because these levels are also high, but let's, for example, just for this example, we just take this here and the 750s actually. So this is our range to trade in, right?
yes.
This is where you would have traded, and let's say you would try to look for buys below, and it depends on how much data we want. Let's say we just need 1 week, okay? 1, 2, 3, 4, 5, 6, 7, 8, 7 here. So
This is
basically
a
what,
possibility that algorithm go against the high writing, call writing or put writing. Is there any possibility that they think like this?
what do you mean?
I mean that if there is a large order building on 38,000, uh, like they short 38,000, okay? So call writing there. And what algorithm is doing on Thursday expiry, it just want to clear those call writers so nobody can get more profits.
Yeah, right,
Is
right, right. This is always possible because if you look, um, the institutions, right, they always have to hedge their positions. So you just need to look, okay, what is happening at the high, right? If you get, like, for example, like I just take this simple basic exercise, right? We have this level here, and let's say we mark out even the round figures because these are the most important numbers actually, because the market is just a numbers game, right?
Yes.
It's all about numbers. So you will look forward for these type of positions, and let's say for one more, wait, not this one, but let's say the 38,500, 38,500. And we just look at these levels, right, and try to make sense of it, what happens above and below these levels. So like, for example, you get to see liquidity high here at the top edge, right? But I can guarantee you that the value in this one was dropping because I knew I knew what gold was actually doing here. Gold was rising in this present moment. So once you see this high here and you see this sort of, where is it here? The sort of top edge forming, right? You see this high volume candle here. You mark it out, right? This is the open. Let's say we mark it open and look what actually happens. This becomes now somewhat of like a buy side, sell side level.
Yes.
So once this happens here, of course you can have it, but let's say I just mark out the open, I really open, you get some type of trade through in it, and this forms now a P shape basically because the volume is building above the level, not below the level. So you would need, and look where the opening price is on this one. It's approximately at the same level, right? So you can just mark it out a little bit higher like this. And then you see price opening up here, but the volume is actually not as high as previously. So you just look, again, look high volume at the top edge. This is like perfect short entry. You get a high volume candle here, and this is your highest candle. So you look, okay, what could this be eventually if just by looking at value, just by looking at value. If you see, okay, value is not doing anything right now, so maybe there is no trade from the top edge. But you can also look at possible right hand lower holds. For example, like you take the swing high and the swing low and you wait for the 50 bounce, right? This is why I personally like to wait for the 50 bounce, because at some point you will manage to get an entry. Like the 50 is always guaranteeing you something. Once you see this retest here and price is holding below the 50, in between here, you can look for something, for some confirmation. Like I said to you, don't toss away your order blocks. If you know how order blocks are working, right? Use them to your advantage. Like, look at this. Like you it's not some type of magic voodoo. It works because this is actually a high volume zone. So if I, for example, take this swing low and this swing high in fixed sessions, right? This will be a high volume node now. Look, if I take this swing low and this price right here, this will be my high volume zone, you see? So in between, if I mark it out like approximately these last 3 bars here, approximately, not perfectly, but this is the POC.
Yes.
So if price is below POC, it was here above POC from this present point. Let's say this swing high, this swing low. Yeah, price was above POC here, but the POC barely changed because once price is here at this point, this is the fib. I draw the fib. Need to draw this box here. Yeah, where is the box? Here is the box. For example, if I draw it from here to here, POC is also down here, right? So this is your midpoint, basically. This is the 50 fib, right? It's close to the 50 fib.
Yes.
So this is your order block. The order block works because it's below the 50, right? This is why it works. If price is above the 50 and you take an order block entry, like for example, look, this order block here, this would be also an order block, right?
Yes.
But why does it? It rejects wrong. It rejects, right? You would agree that this rejects.
Yes.
But
Yes.
but we're below the 50, so the buyers are not in control of this market anymore. So there's no way I would buy the 50 here. It doesn't make any sense. I would buy below the 50 because I would just let the institutions mark up the price where they want to and just look for continuation to sell. And this is what you do, what you did. You actually sold approximately an order block, not perfectly, but there was this type of candle here. It never got hit perfectly, right? Maybe on a higher time frame, maybe on a 5-minute chart or something. Yeah, on a 5-minute chart, you would say, okay, this is now my type of order block because it's last up close candle, bounced from the 38 level here and rejected price down. So once it takes all this liquidity here, I'm gonna be short here, and it just worked out, you know. So what I want to tell you is trading is very subjective, okay? You have to always build an idea around your trade. You always have to come into the market and say, okay, what is my plan? What do I need to do? You know,
Okay.
like I wanted to look at the oil market with you, but you know, we just almost ran out of time, so we'll just
Yes.
look
Yes.
at it real quick. No problem. It's not a problem. We can do a little bit over time. It's not too bad here, you know.
Yes.
But for example, this is now my oil market. I will just delete all these arrows here, all these arrows, because I know you can trade the oil market. This is why it's important that I show it to you, you know. So
Yes.
for example, now you said we move away from the Nifty, okay? So basically supply demand except highest. You this is what I don't understand. You have to use always the highest volume because volume is institutional activity,
But
okay?
I mean that if I draw in 1 hour time frame, so
Yeah,
I got only two zone, suppose two high volume zone,
yeah,
and then I move to 5 minute. So there is more like more number
okay.
of high spikes. So what I should do here?
Personally, like I wouldn't do anything here because I think if you look at the 1 hour, you would get the best volume each session because there is always one spike at one specific time, you know, 15 o'clock, right? Here.
Yes.
Look what happens. We go to the next zone. Where's the next zone? Next zone is again approximately, it's this part here, 15 o'clock. You see it? It's always
Yes.
happening approximately around this time. So there's always one time where high volume comes in, and this is price and time. This is what I showed you on GU basically. So I wouldn't focus too much on the lower time frames. You can use the lower time frame. It is possible, but do not neglect the higher time frames, okay? Like look, this is just perfection, you know?
Why I am saying that because my market open only for 6 hours, na. So if I mark 1 hour, then I will got like 1 2 entry in a week.
Yeah, right. This is like this is what we need to talk about. You need a trading plan and you have to kind of make an idea which are the markets I'm trading. Okay, like for example, let's say, okay, Nifty opens up at 5:30, right?
Yes.
Your time. So you say, okay, I will look at Bank Nifty. Okay, this is one of your trading charts. But then again, you can't only look at one market because if you look at one market, you're gonna miss the bigger piece. So what you can do is you can say, okay, if London is opening, right? London is opening at 8:30. I will take a look at oil. Oil. So you look at oil and maybe gold. So you have now three markets, right?
Yes.
Three markets. Now, I don't know what else you can trade, but
USD INR.
Yeah, you can trade USD Indian rupee, right? But I don't know how to trade that. I'm gonna be honest.
That is bigger sit than Bank Nifty.
This is like I really never looked at it from a big perspective. I mean, I bet you can get some trades, like there is possibility to trade it, but I don't know if you want to do that. If you want to do that, that's cool, but you got three markets which are good, but I would suggest you take like four markets just to study, like maybe one market just for study purpose. It doesn't matter
Yes.
which one it is. It can be net gas or something, right? Net gas, you can trade net gas, but you wouldn't like to trade it. But maybe it fits you, or copper. Maybe you can
Silver,
trade copper.
silver.
So the only
Yes.
possibility in your country is basically be a commodity trader, which is not a bad thing because you can trade commodities. It is possible, like, but for example, if okay, oil is the biggest liquidity market, right? I want to trade that. This is like, this will become your main market. Bank Nifty will become your second market. Will become your first market, and gold on occasions becomes your third market, basically. And maybe net gas, if you can do it, that's your last opportunity, or copper, So
Okay.
you have to kind of how can I say?
Flexible.
Yeah, you have to be flexible. Like, you have to decide, okay, which one makes the most sense to trade? Obviously, it's oil, right? Secondly, it is the Bank Nifty because you like the Bank Nifty. Obviously, it's your stock, you can trade it. And yeah, it's just like this. And then you take XAU, gold, basically, and these are your markets. And if these don't present you any opportunity, you can say, okay, you know what, I will try to look at net gas, for example. So you have four markets, three commodities, one stock, right? And
Okay.
this is just what you do on a daily basis, basically. So you have to identify for yourself. I don't have to open YouTube. I
If
need
you
to.
if you open oil market of my MCX, can you see that is there any problem or I can trade it?
Here,
I will
right?
see
Or on
oil
the
MCX.
with
MCX. Exchange. First,
yes,
crude oil, yes. Crude oil, MCX.
wait, crude oil, MCX here, crude oil
Yes.
futures, right? So you take the crude oil futures. It's just showing you in rupees, right? So I think this is like measured in rupees. But if I take now the RBOB, right? The RBOB is the RBOB is refiner's margin, okay? The RBOB gasoline futures, this is like the refiner's margin. So this shows you actually um what is going on with the refiner's margin. Are they having enough margin to produce oil? These are the oil producers, and you see this line is obviously just perfect with price action.
What is this RBOB indicator?
RBOB is, look, RBOB, if you take RBOB gasoline futures, RB1 with an
Compare system. Okay.
yeah, just by comparing. And if you look RBOB, what is it? For example, we just Google what is RBOB, Brent crack spread, and how to use it. Like, I will take you into this world because I will start to use oil too, because I said I want to know how this market works. But what is RBOB? RBOB is an acronym for Reformulated Gasoline Blend Stocks for Oxygen Blending. It's some type of it is some type of gasoline, right? But what is Brent crude oil? Crude oil is sweet, it's sweeter, basically. It's used for diesel, I think, like something like this, Brent crude oil. And then is what is RBOB Brent crack spread? The crack spread describes the difference between the price of RBOB gasoline prices of Brent oil. So basically, it is a spread, right? And what you can look at is, hold on, you can see it on the daily. It's the RAA one, RBOB gasoline crack spread futures. You see that?
Okay.
So if you take this chart here now, wait, I did it wrong. Crude oil. I have to go back to the crude oil markets and do it and compare RAE1, RBOB gas line crack spread futures. And if you take this line now, you won't see it because it's only showing you on a daily. So if you go to the daily now, you can actually see the crack spread futures, or at least you should be able to see it. I don't know why it's not showing. I hear, okay. So this line here gives you a macro. This is a macro picture.
What the fuck is
This is actually showing you a macro picture of oil, and this is like real shit. Like I just go you to crude light because look at this. If you just look at the price action, this here was already pretty up high, right? Now look what happens actually. Like we can anticipate there is some mad discount and mad premium on oil crude futures, right? So we would only look to sell crude oil from the 80s because 80s is a high open interest, and this is what you can do now. This is why this CME group tool is just very powerful, because you can now look at the crude oil in the open interest. Look, one second. It's loading. Here it is. I need to take my paper out. So we're just gonna mark up here energy, and then you take crude oil American. Oh man, we went in overtime again, but that's not a problem. So you see now this is looking very different, right? But what you can see is 75, okay, high volume, and 80 call volume, okay? So 75 to 80 is your new zone, basically. Basically, it is your new zone. So what you do is, nice, we got the 75, here's the 75. These are the new, these are your new trading zones, basically. And if you just think about it, like you bought 75, right? Because I was talking to you about it, I think we wanted to buy crude oil at 77, right? It didn't work out quite into the lows. But if you look at the bias, right? If you look at the bias, like this was cracking down, but look, you just have to follow the line, right? If the line is actually going up, you want to trade in line with the RBOB. And look, high volume, 10 o'clock, right?
Yes.
Big level, 75. Look what happens. You can mark out the open. You don't have to, right? But what is it based on an ICT term? What is this? It's an order block, right? It's an order block. And look at the hold. But if you take the swing low, swing high here, you mark it out. What is it?
50.
It's shifting. It's a 50 hold, right? It's holding the 50, 50, 50, 50. Boom, rejection, 25. BSG trade. Look, high volume candle in here, low volume down bar. Fuck, you want to buy that. That's the BSG. And look, you take your -2 projection. Look where the -2 projection is actually bringing you. -1 is here, -2 is here. So you can expect prices to eventually rally up to this price here, which is not a bad thing, you know, like the higher the price goes, the better, but you see how clean it is, right? In terms of structure. And this is like a big money market, because imagine from 75 in less it's $5. It's 500 points, which are 50 pips in approximately 1 day. With no heat. I mean, even if you, let's say you're like a big stop trader, right? You bought already at 77, right? You bought below 77, you bought here, right? Because we was trying to buy this low here, right?
There is a news about oil, US, UK oil crisis.
Yeah. There is also the UK oil crisis. These are all fundamentals, you know. You have to think about the big idea. Okay, is there a short supply, or like I can show you one spread. This is the contango backwardation. I don't know if you know it, if you know about the contango backwardation, but it's basically the calendar spread. And the calendar spread is, no, this is contango backwardation. So you take the front contract and the back contract, and then you see, is there actually demand, or I have to add indicator strategy here. I put the VMA on it because I'm on my main account here, so I don't have premium. The close, I smooth it out. I take the style, I take it to a fat line, a blue line. I have to scale it. Of course, I have to scale it. Otherwise, it doesn't make any sense if I don't scale it here. So what do we see? Where do we see the shift, right? Where do we see the shift? The shift is somewhere happening in here. Because this is where price is actually going up. This is on a 30-minute chart, but on a 5-minute chart, it should be very clear that at some point at this low here, like this is opening up. I don't know why it's showing me only this far off data. But okay, maybe on a 15-minute, I don't know. Yeah, but you see how the curve is changing, basically. This is like still sell side because the curve is slowly getting it down. And from this point here, if you would look at it, right, let's say this is like the price action you see. Like I just have to go into the slow here. Like I know it looks stupid. Wait, I will just adjust it a little bit like this. And now we just look for confirmation because we have our big level and we get the response. And look at the curve. Look at how it's changing, right?
Yes.
It's coming down here, but it's not making a lower low at this point. So we look, now it makes a higher high, right? This is like a break in market structure. You have to think about value just as you think about price. This is a break in structure.
Yes.
And then when you see that, right? When you see that, this is still the 50, right?
Yes.
At this point, at this present point, because once this broke already, once this here broke to the upside at, I don't know at which point it was, like if I have to zoom in. Like at this point, once this here breaks out above the 50, you can buy even this big up candle. Like momentum traders are coming in now, right? So you just buy the breakout. You can be a breakout buyer, but you know why you break the breakout, why you buy the breakout. Because even here, let's say you didn't catch this move. Guess what this level is here from this swing low to this swing high? Wow, who would thought it was a 50?
Yes.
And you just go on with the flow, you just have to be mindful about. And if I show you the risk line, which I will show you here on, because I have it here. What is the risk line telling us at this low here? The same shit, right? Just a little bit later, but again in the 50 here. And look, from this point on down candles, even on this down candle here, you can buy it actually. And you would have made profit at least. Like this is a 5-minute. Oh, wait. This wasn't even the whole move here. We have to take the bottom edge here and look where this bottom edge actually was. Look where this bottom edge actually was. Look, wait. I even drew it out because it was so clean here. Look at the volume. Look how long I have to go back in time. Look. Take a look. Do I make this stuff up? Do I make this stuff up?
Yes.
No, I mean, if I'm just presenting you some stupid shit that does not work. Like, this is what I'm always telling you to do, right? Mark out high volume candles.
If there is a volume candle higher than this volume candle, then I will remove this zone.
You don't have to. I mean, in this session, right? In this session,
yes,
on a 30-minute, do you see any higher volume in this session? No.
No, after that.
Yeah, after that, like this here. No, you just mark it out as well. Just mark it out. Just let them on, because think about the idea. It's a round level. It's a round level here. So there is liquidity. Liquidity will always be here, always. And if we have a high volume zone, these are like two confirmations now. We have one, the green line, and 2, the blue box.
Okay.
And now look, boom, we trade down, we reject it. The red line, guess what the red line is, okay? Let's see what the red line is. Why did I put the red line here? Look, session volume, okay?
POC.
It should be the POC of one day, I don't know which day it is.
So what you think about that POC? If market shift from there, you buy.
You see, like I marked out a lot of red. I think I did it here, actually. Yeah. Okay. Look. This was where the POC actually came in. So this red line here should be approximately here. You see, it's always about not one POC, but like more a combination, because this is a whole accumulation zone, right? Because look, if you take all these zones together, right, it's always shifting up, and then it makes a move higher and a move lower back to this zone. So you can take this red line, you can take this red line, you can take even this red line. It doesn't matter, right? It's a confirmation of more zones than one. You always have to think in zones, because also you can say, okay, you know what? There's an order block in here. Cool. You see? You can say, okay, boom. How many confirmations do we have? We have
minimum 3 or 4.
1, the blue box, 2, the green level, 3, the red level, 4, the order block.
Yes.
Okay, we have 4 confirmations that this low here at the 75 is something significant. It has to be. It has to be. It doesn't matter where you close the trade out, but you know, okay, 4 confirmations. How much do I need to enter a trade? This is a
There is
personal choice, of course.
three
But
candle lady, and last candle is also long
yeah,
candle, high volume. This is also a
this is like perfect. And if you look at the 1 minute, I bet you can see some 1 minute price action that will definitely make you want to enter the trade. Like we just look at the bottom here. Like you see high volume candle, okay?
Yes.
So this is interesting. It pins here. Then it takes out C liquidity on low volume. What does this 1 minute price action here make? What does this low make? A buyer's auction.
Yes.
Boom, lower volume, buyer's auction. Look what happens. 75 gets hit. This doesn't hit 75. It hits the order block. It doesn't hit the 75. This hits the 75, rejects it, trades higher. And now we just look. Oh, price is going higher. Price is going higher.
If I mark this zone, so what I always think about that there is a possibility that more high volume candle is there. So I always wait, and then I
but
miss
you always have to think about the zones as well, because this is a 75. We know a 75 is a strong level. Why? Because where is it? Because we looked at the open interest, right?
Yes.
We looked at the open interest. We know, okay, 75 is a high open interest. Like if you see, you have to note one thing. If you get a bullish surge in on the money calls, okay, if this is increasing, this is bearish, okay?
Call side change.
On the money calls increasing is bearish.
I understand. More call writers are there.
Exactly.
Yeah.
It's right the same opposite. It's the opposite to what they teach you. And if you see also an increase in put summary, right? And on the money puts, this is bullish. But look, the bearishness is more than the bullishness, okay? So now you have to identify where is all this call option, where are all these call options, right? Look, they must be at 80. They must be at 80, they must be. And everything below 80, this is called a slippy, because the higher we go, right? 81, 82, 83, 84, 85, like they will, price will start to reverse at these type of levels. You will look at 81, you would say, okay, nice, we got 81, what is value doing? If value is decreasing, you want to short 81, above 81. If you see it goes higher and the value is still down, you short 82 and you short the levels in between, the 50s, you know, like the mid figures. And this is what we will look next week, because trust me, you will get one huge oil trade. You will get one huge oil trade because we hit the 80s now. We hit the 80s. And we know, okay, look how it responded to the 80s, right? It didn't respond well. It didn't say, oh yeah, I accept the price of 80. It went all the way from 80 to 78 80s. So let's say, let's mark out 79. So this is about $1 on oil, right?
Yes.
This is like a $1 move on oil. These are like 100 points. With a one lot, this is like 1,000 pips, I think. $1,000, I think. Not quite sure. But just by marking this out, right? And
Last question you have
yeah,
to also know. So if I observe oil, so
yeah.
make a list for, so what should I think, what I should look for? What
Okay.
things should I look?
Okay. So first you look at the macro picture, okay? This is like the first thing in business. You always look at the big picture. You
Okay,
say,
daily.
okay, the daily, yeah. You look at the daily, you say, okay, where are we? We are at the 80. What is 80? Where could the next big liquidity level be? 75, maybe 77, 70, maybe in between even, you know? So you take the 77.50s too, because this makes it now, what is the 77.50, right? You don't even have to take your FIBO out because you know this is the 50%, right? You
Yes.
just know this is your 50. So you mark out your big balance areas first. You say, okay, look, this is my big balance area from 75, from this low here, swing high, swing low. This is my 50, this is the 75. You look for these type of zones. So let's say I just mark it out like this. I don't need the Fibonacci anymore, right?
Okay.
So you look, okay, what are we doing at the 50? What is the volume doing at the 50, right? Once we trade down into the 50, is the volume increasing? Because if it's increasing, that's good. More people are inclined to buy at fair value. But what is our value doing? So you look at the RBOB, right? The RBOB, you can also use the high yield junk, right? Against the Z nodes. Yeah, right. Minus the Z nodes, I'm sorry. The high yield junk. The high yield junk is a market which is, it always says high yield corporate bonds, right? So this is very risk on and this is very risk off, because bonds are correlated to the dollar and the dollar is a risk off asset. So when we compare these, do you see how clean the line is actually? The line is just as clean as anything else basically, because if I, for example, take the SP 500 here, this line here moves together with the SP at all times, basically. And you have to watch this from the New York Open. So from the 1530, this is where the open is, and you see this is basically giving you a momentum trade all the time, basically really all the time. If you look at it, this is where the market opens, right? Oh, no, wait, wrong time. I have to use it. 1530. This gives you a momentum trade because look at the volume, right? So in this period, so in this session, this line is popping down, right? So what you're gonna look for is short top edge liquidity, basically. So you short it, you get a nice profit. You short it, you get a nice profit. But look, now the spread is trying to bounce up, right? So you look to actually, it depends. Okay, it doesn't make any higher high here, so you can't really buy it. But at some point, hold on, did I scale it? Yeah, I scaled it. This is basically the, what is it? This is the, this was yesterday's market. Basically, you could have bought it, but sometimes you see this is like, it moves very accurate. It was this time here. Look. This is what I actually marked out. So the 1530 candle, this is going down. So you look, okay, see liquidity, this is going down, you want to short the top edge, 4 candles, nice profit. Okay, it starts to consolidate at this point here. So there's no trade, but this was from the open, you know, like
Yeah.
5, 10, 20 minutes of selling until the value starts to kick up again. And then you just say, okay, final trade, I'm collapsing it. It's done basically. And once you see this, look, the spread is kicking up to the upside. It depends on how much the spread is kicking up.
This spread you see that the sudden spike upside. Okay. So
Yeah,
what I should always wait for retracement and then buy because I can consider this as a
yeah,
institution sponsorship.
yeah, but you see here is no real retracement coming. So you have to be kind of, how can I say, it's really tough to get on sharp moves like this because there are some dead periods. You see this is a dead period, right? Until the London Open at 10 o'clock. But on the London Open, only the high yield junk is opening and the ZN is only opening at 15:30. So you always have to wait for this line to go at 15:30 because then it starts to be accurate. Before it's not accurate. So this is just, you don't have to use these lines. You know, if you don't know how to use it, I like to use it on my GU market actually because it gives me clear indications. You know, like this is my market. This is what I do daily. This is my daily market because I just understand it, you know.
Yes.
I just understand it, how it moves. And if I just put the risk line on here, like this is a no-brainer shot. Look at this. Look at this no-brainer shot, right? This
Yes.
risk line is totally collapsing. Gold is way up high. And if gold is high, this is risk off. This is NFP. I'm thinking, okay, we have NFP, we have gold going extremely high. GU has to drop. It doesn't matter from where. Even I try to get short here. Little profit, okay, it comes back. I don't mind to short it, but when it comes back here into this level on low volume at 17 o'clock, I say, oh, fuck it, I'm a short this and I get my 20 pips and I'm happy, you know. I didn't get the buy maybe, but it doesn't matter. You don't have to get all the moves in a day, you know, you just have to get the lion's portion of the move. Like, for example, on oil, you know, okay, this is the top edge at 80. I want to look how the 80s are reacting. There is another block I'm seeing on a 5 minute. Boom. I take the trade. Thank you very much. 10 pips, maybe like 10 pips. Boom, $1. And you need to be happy with this because you can do this every day. Every day the market is opening and the market will be forever opened until you live. Even when you die, the markets will be there, you know.
Yes.
So you never just, you have to eliminate the thinking that
In
you
this
have to,
segment, yeah, can you see the high spike green volume
this one,
candle?
this one.
Will you mark the open of this candle or not?
You can. Why not? Because if you're a scalper, right, you just mark out this candle and you say, okay, buy side above, sell side below, right?
Yes.
And if you're a scalper, like a scalper is looking at the 1 minute, you can say, okay, this is my bar actually. This green bar here is my bar, and you mark it out completely. So you see, boom, it trades down, it trades above it, it pins it here. This is a low period session. So you have to be mindful. So you say, okay, what is the risk line doing, right? The risk line didn't do anything special in here. So at this point, you would just say, I'm more inclined to sell the top edge. You see, you would rather sell the top edge here, maybe here. Like this would be a safer trade. You see, like if you this sell here at this point, look, do you see the divergence on the 1 minute?
Yes.
I mean, it's a 1 minute chart. You can't really look at the 1 minute divergence. It is possible, but you have to look at least 5 to 1 hour. 1 hour is the best value you will get on every single trade. Like you have to be mindful. Like for example, if I show you this here, right? Like just structure wise, this price is making higher highs, right?
Divergences.
where this is making lower low. So you know, okay, I want to buy, but where? This is the question: when and where do I buy? That it is a buy. This is logical. Okay, you can see, hey, this here must be a sell. Okay, therefore you're gonna sell it. You sell it. It comes back up. You say, oh man, okay, I will sell the stoppage. I won't actually, you won't sell the stoppage because this is making higher high, so there is no sell. But at this point, when this drops and this rises here, at this point, this is your sell opportunity now, right? Because look
Yes.
at it. Look from this high to this high, and from this high to this high. This is now a real selling opportunity, and look what happens. At some point it goes, but when this here starts to crack up, you want to exit your position somewhere in here because you know, okay, something is about to happen. And once you see this big pin bar, you see value is increasing, you say, I'm buying it, right?
Actually,
And once
what I think that when I see this is like a retracement, slow money. So
yeah,
why I should avoid that selling. And if you see the green bars is randomly goes up, so this is a smart money. So my trade should be always in the buy direction.
yeah, I mean, you always how can I explain? If I take a line chart, you know, and I just delete everything, you see where the slow money, where the fast money is. Basically, if I go to a 1 hour, this is a 1 hour chart, right? And look, fast money, right?
Yes.
Look, slow money. What is it? What is it? It's a 50 bounce, right? It's approximately a 50. But look how it reacts again. It goes up fast, it goes down slow, it goes up fast, it
Yes. So when I
consolidates.
see, I think that I should avoid the short entries because I am not good with the short. So
Yeah,
I
yeah,
have
of
always
course.
avoid.
You have to get used to it, of course. You know, you can't be a pro from overnight, but what you can do is you mark up the things you know. Okay?
Yes.
If you, for example, know, okay, I know my supply demand zones, I know that they were working, I know my round figures. I know how the institutions accumulate their positions, like compressed price, right? If price is really compressed, like into this low here. Look, price is fast, right?
Yes.
You see some green candles, you see some green candles, you see some green candles, three large red bars into the bottom edge. And then a pin bar. Pins are always important because if you look, see, there is no pin bar maybe here, okay? But you see this is like liquidity, and then it pins back in the range, you know. This is not acceptance of price, this is rejection of price. They don't accept lower prices on oil. And then you have this beautiful auto block here, of course, which can help you out a little bit. And from there it just goes.
Actually, I was watching the day one session that you sent me. So Ray said that that pipe structure is also a pin bar when you change the time frame of higher.
Yeah, yeah, definitely,
Yeah,
definitely.
yeah,
If
day
you
one.
go to a daily, for example, you just look how beautiful it is, right? How the close is. But like if you see the top edge is also pinning, right? And this is high volume. So you can't sell this bar. I mean you can, but you shouldn't be actually selling this bar actively. Only if, for example, the value, the REE, which is down, actually the crack spread, the gasoline crack spread, when this here is pointing down, but it is not pointing down at this present moment. So this is down, but if you look at it, this is on an uptick, right? So this line closed on whole uptick. So you wouldn't be very inclined to sell this. Like it,
Okay, and
like you know, I could talk forever, man, but we just don't have the time. And what you can do for oil, finally, what you can do for oil is take the US 10s and the US 2s, which are the
uh,
best indicator. The best indicator for oil is this one probably, because this shows you also risk on versus risk off. And now look, if I just delete everything, right, and just do you see how clean it moves?
mm, yes,
Like I did nothing. like literally, I went back like this, right? And then I just press auto and it shows you the price. And look, this here is a big flattener, right? This is going down instantly. Why price is
Yes.
very slow. So you mark out this low in previous time. You already know, okay, this low here, this box, this is a box. And it makes higher highs from here. It makes higher highs from here. So when this comes back and pins it, this is like the perfect opportunity to buy.
Actually, value here make a double bottom after a retracement move.
Yeah, right. It makes the
As
bottom
it is.
like
Yes.
look, where's the time? Where's price date range? 16 hours before the price actually drops, this is already marking up the price because it shows a reaction. It goes higher. The 10-year yield is increasing, and when the 10-year yield is rising, you're inclined to buy the oil market, as you see, right? And if the 2-year yield is actually like, look at this divergence. Do you see it? This is like perfect. This here is at 6 o'clock. This here comes in at 8:45, and it doesn't make a higher high. So you know, okay, see liquidity, value divergence, goodbye oil. We're gonna short this. And then you just look at the structure. Boom, boom. It comes up, boom. You just, even if you miss the top edge, right? Look how many opportunities there are to short it on a 50 pullback. Like if I just take, I just have to put my fractal indicator on. So you take the swing low, the swing high. For example, like previous swing low, this is your bracket area. You see, we come close to the 50, we pin it, we come below it, we pin it, and then you have like all these order blocks. You can use order blocks in your trading because these work on oil as well. You see, you have like, let's say, one entry.
Price- Actually, price multiply itself of its balance area.
What?
But actually, price multiply the balance area for the target.
Yeah. This is also true because if we take out the swing high, the swing low, for example, you can see where the profit takers are, right? This is like you for example, let's say either time you switch your balance area, you can say, okay, I take this price to this price, right? From this swing low to this swing high. This gives you a perfect projection to the bottom. Always, it has to. Like if you take this one and this one, this will give you a -5. And basically now what you wanted to know is how to trade, okay? So when you look at this market, you have your macro view.
Okay.
Then secondly, you need to look at your fundamentals, at news and all this stuff.
What is happening in oil? Okay.
You have to look what happened in the past. And when you understand what happened in the past, when you look backwards, you can look forwards. This is very important.
Okay.
Then you need value. This line here, this is a value line, okay? You can use this one here, you can use this one here, and you can use the RBOB for oil.
Ah. Okay.
Yeah. I will do as quick as I can, man. So take these 3 lines, okay? Write them down. These 3 lines for oil. These are your value lines. If you just have to look one by one, but this is the most important one, the US 10s minus the US 2s. This is the best value line you can possibly get because it's just perfect. It's just, you see, there is divergence. There is some divergence. Like here, for example, look, like this is the perfect divergence trade. Boom. It doesn't make a lower low. Price from this point here is making a big discount. So everything that goes below here, you want to buy that. Oh man, come on. Everything that goes below here, you want to start buying the lows. Not necessarily the highs, right? But if this pins up, you're inclined to buy it. And if it comes down aggressively like this, you say, okay. Also, macro, of course, macro 75, your big levels, you have to mark out your big levels. 75, 80, the midpoint, 77, 50s, the round figures. Every figure on oil is important. Every round figure, every $10 or so is important for oil, and you will recognize that. Because if I just move $1 up, right, you see it has some reaction. If I go to the 77, it has some reaction. All levels on oil are kind of important, but you have to use them together with value in your favor. So you have value, then you have time of day. Time of day is important. You have to look at the London Open and of course the New York Open. So it's basically from 9 o'clock to approximately, let's say 10 o'clock somewhere, or let's say 11 o'clock. I would say this time window, and from 15, from the cash open, from 15 to the close, basically.
I think in my market, this is 7 p.m. That we talk about some days before.
Yeah, you know,
We talk about that you will trade. So I said that, okay, I will be there at 7 p.m. when oil we were watching.
yeah, like you have to frame your time when you're able to watch it, because it's not like
Okay.
you have to be active in these type of sessions, you know, like you don't
That
need
I
to
will
look all
consider by looking the volume, high volume.
exactly, you know, you look at the high volume and see, okay, where is the most volume in here? Obviously it's from the cash open, which is 15:30 my time, to the close, basically. And then you also look at the London volume, because it's a cycle, right? If I just put this here off, and if I put value off, and you just look at this day here, you can obviously see it's high volume at 10 o'clock my time and 16 o'clock my time. So London and New York, basically.
I am
And here,
ahead of 3 hours. Okay, ठीक. Okay, okay. I will figure this out.
yeah, we can talk about this maybe tomorrow or something. And then liquidity, level 2 liquidity, you already know what this looks like, right?
Yes,
We had
yes,
that on GBP USD. So
yes.
you need to spot L2 liquidity. Then you have your volume nodes. I showed it to you, I think, right? The red lines.
Volume nodes means POC lines.
Yeah, the POC lines, exactly. Look, wait, I will just go back now. I will just have to go back now, really, really much.
Where all of the POC lines consider in the accumulation.
Yeah, you can, this is reaccumulation, right? Exactly. Like here, you see, like a lot of levels, I know lots of mess, but you can see this level here, for example, right? POC level, POC level, POC level. So the red lines, these are called volume nodes, basically, because this is the highest volume from the previous day session, and these can show you either reaccumulation or redistribution, either way.
So look for the volume profile of the session.
Yeah, exactly, exactly. Okay, the next point is price action. And volume, of course, buyer's auction, seller's auction. You look at the price action, you look at the structure, you have 50 pullbacks, higher holds, bar by bar analysis. If you see an order book sweep, you look, okay, is it possible that price will go up? You have to really make a picture of it, okay? And then on my plan, there is order flow, but you don't need to use order flow yet. I'm not really into this type of NinjaTrader stuff, which is Ray using right now, but at some point I maybe will, and
That
then we
way
can
you
talk about.
yes, by seeing the number of orders. in
Yeah,
the bar.
right. Like deltas, absorption, exhaustion. You can see it on, how can I say, like this is obviously absorption, right? This is not exhaustion, or maybe this is even exhaustion, but absorption is happening into low prices or into high prices. So as price goes higher, somebody is absorbing the price. And
Yes, I mean
it's
high volume and low candle.
Yeah,
Pin
exactly.
bar
High volume,
candle.
no candle is exhaustion. Just it's a
Yes,
withdrawal of liquidity. I think I've sent you a PDF file once.
yes, yes. I have that.
Yeah. So, and then you have to, the most important thing is the roadblocks. Roadblocks are just gained levels. So how many times will they fade the level, right? Because if you see an institutional accumulation, you can be almost be sure that it will fade once, 2 times, 3 times, right?
Yes.
And then
So, I mean, what you wanna say that I should look for the liquidity graph in the order block.
Yeah, you should, how can I say? You should just be aware that something that is obvious might so if you think the trade is too obvious, okay, if you think, well, this is the trade, then you should probably wait a little bit longer, because if the trade is too obvious that everybody can see it, it's probably not the right trade, because the best trade is the one which nobody can see, right?
Yeah,
This is
I
the
have to
best trade.
also think that what retail traders are thinking here.
So you have to be aware that something might happen that is unexpected. So you have to be always mindful of that unexpected moves. And the last part is trade management. You have to be proactive. You have to be really not, you don't place your order and then you go shower or go to the kitchen and cook some food up. You
I
can't
never
do
do.
you can't do that. You can't do that. You have to have a hard stop loss and you have to always look at the chart.
Yes, yes. What is this hard stop? What do you mean by hard? I mean, what I
What
think
your max
put it
pain,
just
this is your max pain level basically. Where to put
oh,
your stop loss is basically hard to say, but if you enter at the 50 level with value in your favor, then you just put your stop loss below the 100, you know?
okay.
But if the first, you have to understand that in order to put the trade on, right? You have to fulfill all the previous steps, because if you just put the trade on and then think about liquidity, time of day, and the value and everything, then your trade is gonna get screwed, you know?
Yes, like in this chart, I can see that there is a like buying in the red volumes, red candles. See,
Yeah,
so they are
exactly.
buying it. So I can
Like,
wait. Then I figure on that out. Yes.
yeah, like for example, if price is marking up like this, you don't want to be a buyer in here or in here. Like you don't want to chase price at this point because the trade is already gone. You really want to
Yeah.
focus on top edges and bottom edges, basically, even if the top edge doesn't pay you, right? If this is the top edge trade and you just short it from the 80 level and it gives you a little bit, you go break even, you take some profits. But the same goes for here, right? If this takes out liquidity and you buy it, you can move your stop to break even, and break even trades are not bad, because what will happen eventually is at some point, once you understood everything, your equity curve, right? This is, imagine this is your equity curve. Your equity curve will look like something like this. Like it should go up, break even, go up, break even, it go up, break even, break even. Let's say you lose like one trade, you lose, let's say you win on every trade 1%, right? 1%, 1%. On every trade you win 1%, and the break evens are always zero, right? Then you take a small loss, like you take 5% minus 5% loss, right? And then again, maybe you faded a level and you got stopped out, okay, but you keep the bias and then suddenly you get like 2% out, and the equity curve is always the equity curve
This is
can't
like
go.
a prop desk trading. They always always book profit in the flow and they get loss at the bottom edges.
Yes, exactly. Like the curve should never look like this, like never. When you're a desk trader, you always have to, if price is going from one point to the other point, if you at zero and this is one, your stop loss is already break even plus one at least. Then it makes a 50 pullback. You maybe already booked some here, and if the trade goes, you already add another position in here. So one plus one. Now you got plus two on your trade, you know?
Yes.
And this is just how the prop desk traders trade. This is basically what they do. That they can't allow price to they can't allow to give price they can't allow to give money
They
back to
want
the
to
market.
remove the traders at the equilibrium from the 50. So they come back again and take their trailing stocks and again
Yeah,
go.
exactly. They just look for liquidity basically. This is all it matters. But you always have to think, if price is moving right up, you
Yes.
just think, move your stop loss to break even and just hold on to the trade, hold on to the trade until you until you finally get the measure. Because if I take now the price from here to 70, right? Where do you think the price will bring me eventually? Price will obviously bring me into these highs here at -1 and of course -2 at some point. But you know, it's Friday. There will be profit taking at this level. You also have to be aware time of day of week, right? Who would
Yes.
not take profit from here to here?
Yes.
It makes perfect sense. It doesn't mean it's a reversal trade, but it's definitely profit taking. Definitely.
So should I trade on Friday or not? I think I should avoid.
You can trade on Friday. You have to make your own rules. You can say, okay, on Friday I will only risk half my standard risk. So if you risk 0.5, you only risk 0.25 on Fridays.
In my market, I observed that there is a order building conditions built because premiums are high on Friday after the expiry of the Thursday. So there is a possibility that big money make position on Friday.
Yeah, on Friday for the next week.
Yes.
Because this is basically how institutions accumulate. This is like the weekend, right? They try to build up orders into the weekend. So if price goes down, they already have their money in the books basically. So they know, you know, they know that nobody is trading on Friday, and this is good for them because they can do whatever they like to.
Okay.
This is why the curve, like, look, if I, for example, just 10 minutes, okay, we quit in 10 minutes, I promise you, man.
That's okay.
Look, we take the SP 500 and we put the chart off here, and we just go back a little bit. Like, I need to put this is actually the wrong here. I need to put the let's take the Nasdaq. Okay, Nasdaq, and I delete everything. Like, if you take the curve, right, and you just look at curve logic, like, for example, this is the close, okay? This is on the 1 hour. We look at the 15-minute, for example. Let's take a look at the 15-minute. You look, okay, what are they doing into the close? Okay, are they buying or are they selling into the close? Obviously, this is buying, okay?
Yes.
So when price, I will just make a guess. Price is down into the close, okay? 50-50 chance. Nice, right? Price is down into the close.
I
So
mean, they need a red candle to buy the market.
yeah, exactly. They need this candle here, this pin bar here on high volume, right? They need this pin bar here to buy the market. And look, let's see what happens. Look, the curve opens up. Is it any surprise now? Like, okay, I understand, right? This was not a big move, right? This was like 50 minutes, 30 minutes, 1 hour of buy side action approximately. But look what happens. Price comes back down. Price comes back down. Now look, of course, the value is also not improving at this point. Okay, you have to think about this point here, like time price, of course. You have to think about this. This curve is not making higher highs. So you switch your bias. You switch your bias because you see the C liquidity grab on a down volume. You want to be engaged in selling. But from the close, if you buy the close, right, you would get some profits, a little bit of profits at least. Because this curve was up and they traded basically up into this liquidity, into here, into this high price. Let's say you exited here, you didn't do anything. So once this happens, and then you get the C liquidity top edge, you start to engage in selling. You engage in selling because the price is making lower lows, price is making lower lows. We take our liquidity and now look what happens actually. Price is making a big high here on this red bar, right? Let's say 8 o'clock, approximately 8 o'clock, this is the London session, right? We just see this, we want to buy this bar. We buy this bar, look what happens. We get a little nice profit, right? It's just scalping. It's just really, you buy the close of this candle because you see the value divergence in the last 1, 2, 3 candles. You say, this looks good, I can buy the close. And if you buy the close, you don't have any at least problems, right? And then look what happens.
Actually,
The
what
value,
they always do, they always check the liquidity on the both side of the balance block that we call that block profile, and then they shift the price to the new zone.
yeah, exactly. They always test the liquidity levels because this is now a liquidity level, and based on the structure, right? This looks
So
like slow accumulation because this is slow money now in the big picture. But what you see is at some point, like for example, value is kicking down at this point here, price is going up. There is no real trade in here. Like if I just mark this out here, there's like no trade, even though maybe you have to use a little bit of different value, like the ES, for example. But even the ES doesn't offer you anything except a short trade at the top edge, right? Like at this point, this bar, when this bar comes, what is this bar called? Like I told you many times before,
why order block sweep?
order book sweep. Yeah, exactly. Just think about it. Value is down, order book sweep. What will
Yes.
happen in the next 1 hour, 2 hours? It's just gonna sell off because value is down. Price took out so much liquidity on both sides of the market, probably due to news, right? October the 8th, this was NFP. It was NFP. This was an NFP trade. Sweeps the order book candle, right? Sweeps the order block, sweeps the order book. Then you get a low volume retest. It doesn't break the high, but it breaks the low. And once it breaks the low, I mean, you can be aggressive. Like if I go to the 5 minute, for example, like this together here makes the order book sweep. But even on the 1 minute, there should be an order book sweep candle, which we can identify. Where is it? Here is it. No, actually there isn't. But on a 15 minute, we can see it on a 15 minute. I think it should be enough, but
Well, if I go for every setup, then I will face loss. So I think that I should consider only my setup.
yeah, but basically this risk line, right? It's the
Yes.
same as the GBP USD trade. If I take GBP USD, for example, just in this equation, just to show you what actually happens. GBP USD is at an high, right? And this risk line is at a low. So this price moves fairly the same as GBP USD. Approximately the same. Not perfectly, but approximately. So at this point, you see this order book sweep, you see this high, you say, okay, GBP USD is at a high price. You marked everything out, right? Everything is on spot. You know, okay, this will be the reversal bar, and look what happens. Price doesn't trade above the high. Your stop loss would be above this high. Your take profit would be probably below this liquidity here. And this would be your trade outcome for the rest of the day, basically, just because you identified the order book sweep and the value divergence. Yes,
So
value divergence.
I should enter in the 50 of this order book sweep candle.
You can actually pull out your Fibonacci and enter at the 50. Like here, for example, you take the 50% here. This is the range now, right? Swing high, swing
Yeah.
low. Then you look at the price action on the 1 minute, for example. You just look at the price action on the 1 minute. Where is it? Where is it? Where is it? Here it is. And look how nice it is. 75 rejects, right?
Yes.
No 75 price. What happens? 50, we catch below the 50, we catch a break, boom. Now we're below the 50. What
Yes.
happens?
So
We
my
trade
thought
down
is
to the zero level. We came back. Now we have this is a true right hand higher hold basically. So you want to
yes.
sell the top edge on this right hand higher hold at 75. This is like, this would be the perfect entry here. The 25, because we broke structure to the downside, you know, okay, this
Yeah.
order book
Lot
sweep
of
is now a good order book sweep because it shifted value constantly, right? So the
yes.
next short you have, is probably something like this. You short your positions and you say, okay, it shouldn't go above here, and your your target is basically below these lows here, like this liquidity low. You say this is a one-to-one trade, okay? Like it's nothing special, but it's a safe trade, you know? It's not a
Well,
big trade.
our HX trade R comes after break of structure kind of thing. They are little bit late that
Yeah,
you
yeah.
don't want to.
The order book sweep is a breakout structure type thing, right? Because it's actually even powerful on a 1 minute chart. Like for example, if I just show you this candle here, right? It is not a real order book sweep, but you see this here is taking out high low, but it's not a swing. So sometimes it doesn't show the fractal, right? This is like on a 15-minute
Yes,
EU
many
looks
times
just
it not factors.
the EU candle should look like just should look like the other candle, but it's not. It's just a high price pin. So there's no order book sweep. But these order book sweeps always have the most significance at high prices and low prices. Like for example, this bar here, right? Like do you take this high and low here, you know, okay, somewhere like, yeah, like this here. Now you have your balance area and you see this is already a lower hold, right? I don't even have to draw this up for you
Yes.
because this, it's just the element, you know, it bounces here, it just chills below the lower hold, and then you have the -1. And now if I go down the -2 road, you know, like
Yeah, so
-2,
yes,
look,
lots
boom.
of things that is a B structure. Yes, lots of things.
Like structure is really important to all these elements. But like I said, you have to train your eyes to see it. You know,
Follow stop. Where is the stop? Yes.
it's like really like trading is subjective, you know, this is the thing. Trading is a really subjective topic.
This will
It's
come
not,
with the experience, I think.
yeah, of
How,
course, because
how many hours I watch the live market? How many
yeah,
hours I will pass the chart?
me too, man. Like I'm sitting there and watching the 1 minute chart for like 1 hour, and then I need to take a break because it's just too much information, you know.
Yes.
Like I'm waiting, and I'm getting the trade, okay, but the thing is, you have to be active with your thinking. You have to think about all the stuff going through your mind, and you think, oh man, can this be, can't this be, and what happens if, you know, so many questions are popping up, and it's a really stressful job, but once you mastered it, it's like a game, you know, it becomes like a game.
Yes.
Like if you have your model, once you have your model and you trade your model, like,
So your model is done. You said that I will complete this week.
yeah, this is basically my model. Just what I read to you is my model, the trade commandments, the macro view, the fundamental, the short-term value, the time of day, the volume cycle, liquidity. Then I need price action, and that's it. And trade management. And this is what I look for my GU market all the time. I look at my levels. I have my levels because I have my order blocks, my volume nodes, my 50s, my what else?
Yes, yes. I
Liquidity
also write
levels,
down things I will show
supply
you.
demand, yeah, supply and demand, all these things. And if you get more confirmations and more confirmations, you just get used to it, you know, and you just start trading it. And once you start trading it and it works, you know, okay, I mean, losers will occur, you know, you will get losers, but the art of trading is to keep your losers small and let your runners run. This is basically all there is to trading. If you're new to trading, right? Like on a daily chart, for example, let's say you're new to trading, the best advice I would give you is to buy low and sell high, right?
This is like a price property that it always get for
This is
high.
this is this is basically the first rule in business, right? Buy low and sell high. Like just for example, like you see this is liquidity, right? This is liquidity and this is also liquidity at the top edge. But like for example, you would have bought this here and you would get like 1 day of drawdown. Let's say you're a big trader, like a newbie trader. When I started trading, I would hold my trades for weeks, not weeks, but for a whole week. Like I would place 1 or 2 trades and just hold them because they were negative, like they were this negative, really, they were this negative, like 40 pips negative. I didn't use a stop loss or anything. I just held them. I had like on a $1,000 account, I had like $400 drawdown, like 50%. And I didn't care, right? Because I was a noob, I didn't know what I was doing. And then suddenly the market turned, right? And I thought, oh man, I'm such a good trader. But
Yes, I did this with the demo, that FTMO demo. What I did that I always put the order in the spread, like one lot, two lot, three lot, below the old high and old low, and then price hit and it go come against, and you are in the profit.
yeah, I mean, it's just, you know, it's just a progression over time. Like it is like, how can I say, a profession. Like you have to study it for years, not months. I see all these traders, you know. I remember the one time where I tried to introduce a couple of people just to divergence with copper and oil. Because if I, for example, I take the copper, you know, and these guys they laughed at me because I used this type of stuff, right? He said, haha, this guy is using some lines to determine where the market is going and all this stuff, right? But that just shows you that these people are really just having no clue whatsoever what's happening in the markets. Because like
Actually, when ICT teach, his first lecture is about yield. And I thought that what is this interest rate and yield? This is garbage, leave this. Everybody, I think, thought that.
yeah, like I mean, it's really, how can I say, like the copper and oil market, they are closely related. Why? Because they're both very much risk on. What you can do is also, this is a risk line, which is copper against gold. And this is like also a risk line. And if you take this, you obviously see that there is also some correlation, not only a little bit of correlation, but big correlation actually, because you see, I'm just going
Yes.
price by price, and the price is actually just look at this, look at this.
Yeah.
Look. Boom, 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 boom. The risk line is down, right? What is the trade? What is the trade? Look, once this risk line is going up, right? Like from this point here, from this point, the down candles are getting bought up, right? Somebody's buying the up close candles now.
Yes.
And at some
Clear.
point, look, now it's dropping. Boom. It's dropping, it's going up, it's dropping, it's going up, it's going up, risk line is up. And at some point, boom. 78. Now look what happens to the risk line. The risk line is down. What's happening at the top edge? Top edge, it's getting absorbed. It's getting absorbed. This is now a higher time frame accumulation, basically. But at some point, you see it?
Yes.
It comes back down. It comes back down. This is the level we talked about. We know at some point these lines have to correlate together to make sense, because this top edge here doesn't make any sense. This value here, this is a premium, a big fat premium. And we knew that with the US 10s 2s, we knew that this was a premium. We knew before everybody else knew this was a premium. And then look, boom, the price just goes in the same direction, right? Picture perfect, picture perfect. It's just,
If I sell the high and I have enough money to hold the trade, then I will never be in the negative. I think.
no. If you follow this line, right? I mean, I would never suggest that you do this and trade without a stop loss. It doesn't make any sense. But if you follow these lines, right? These lines that I'm showing you, it's you have almost no possibility of losing a trade, or at least for the meanwhile, maybe you're sitting in some drawdown, maybe you get a couple of scratch trades that like you lose maybe 0.5%. Okay, it can happen. You lose 0.5%. What a biggie. At some point, at this point here, when this here is at the bottom edge, right? And this is at the top edge, you just look at it and say, hey, fuck this, I'm gonna short it because it's London, it's diverging with the risk line. The risk line is showing me clearly that gold is favored and copper is just dead, you know, copper is dead and gold is just, it's just risk off. It's risk off. And for the next like what? One day, for the next whole day.
Volume is not happening on that green bar.
Yeah, because look at this, from this point here, from this point here, right? You get to here, you get a buyers or you get a seller's auction, right? And price is going okay high massively, right? But this is what you like to see because this is a 1 hour chart. This is for me personally, this is a macro trade.
Actually, that is, I always do this, and I'll always wait for the stopping volume in this condition. And sometimes it comes, sometimes it not comes. So I
Yeah,
miss that.
but you also have to look at the right how can I say, the right time. Like for example, if you take this high here, this was the high here actually. Like this was the high. The stopping volume here, it never comes in, right? Here, for example, it never comes in because you have to just look at other elements if there's no stopping volume. Because what you see now is from this point here to this point, this is a seller's auction, right? So nobody is actually buying it. I mean, there are some buyers, but look what happens at the buying from this point here to this high here. It's again a seller's auction. You see how
Yes,
this here, so increasing volume, decrease in price is a seller's auction. And then you see the decrease in volume and the increase in price, which is also a seller's auction. So you think there is an order block here, right? There is this order block here with just look what I'm drawing. I'm drawing some bullshit, you know? Like, and
yeah,
look how the
figured it out. Yes.
and look how this trade works by just identifying a little bit volume analysis, some levels like the order blocks, maybe a 50 pullback. You know, if I take this swing high, this swing low, this is approximately a 50 pullback. Not a perfect 50 pullback, but it's an area of a 50, right? It's not the perfect 50, it's an area.
Yeah, Ray talked about this yesterday that when you want to short, wait for retracement, see the volume. If you are in the seller auction, short it. Yes.
Yeah, exactly, perfectly. And then look, you have the target. You say, okay, I'm shorting to at least this level here, which is a round figure. So you mark out this price and you exit here. Imagine you exit here, right? And you just wait. And then you see this here happening 1 hour later. And you have your levels marked out. You already know, okay, my exit is here. I pass on this little move here because I made enough money from this 50 here. And then you just buy and do the same shit over again, you know, like I can't explain, man. It's like
Fat candles. Fat candles are very important. Yes. Yes.
so next week we're just gonna look at the oil market, you know, like I will cut it here now because we're in 2 hours. Again,
yes.
like always,
I
it's
have
it's always like that, but you know, it's just important to see it. And next week we're just gonna work on the oil market. We're gonna look at it all the time and just build ideas, make trades, and just do what we do. We are traders. Our job is to just place trades, you know, place orders, look for the right things, get onto the trade, and just work it. So this is what we will do next week.
Then big thanks for this session. And you are going to your grandma home.
Today, no, actually, but eventually tomorrow. I have to clean my apartment now because I was yesterday in training. I didn't. Yeah, it just looks a little bit messy, you know. So gotta clean up the kitchen and all the other stuff. Maybe do a little bit of just a little bit of household, 1 hour, 2 hours, and then I'm free for the day. And we're just gonna enjoy it. We have a little bit of sun here.
Okay.
So yeah, I'm just gonna. I hope you have a great day too, man. Enjoy it. Take some rest. You know, don't look at the markets. Take a look tomorrow. And
no. I also do some reading for my job, so I can.
This is good. This is good, man. This is also important, you know. So I will stop it here.
Yes.
I will just stop it now because we're already done, man. You know. Okay.
Yes. Very
so
thanks.
no problem. We're gonna hear from us tomorrow, Monday, Tuesday, Wednesday, Thursday, Friday again, and we're just gonna now actively. You're gonna trade the Bank Nifty because when the Bank Nifty is open, I'm at work, so I can't help you with the Nifty. You have to get there on your own 2 feet. But when the oil market is basically going up, I will just.
I think I can handle that with your knowledge. You teach me a lot, and now I can handle some. At least I will not face big loss now.
Yeah, this is the most important thing. You just keep your losses small and your winners run. And over time, you know, it's really a large process. It's not happening from one year to another year. It's like if you trade 4 years consistently, you are at a level where it just seems that you like just always how can I say, I always imagine myself with the knowledge I
How
have
how
now.
how much time you are trading from how much time?
Yeah, exactly. Like even in 4 years, right? 4 years is like
But
people
this is the
think it's,
question. This is the question. From how many years you are trading?
yeah, but how many years you're trading? Because Ray is trading approximately now 35 to 40 years.
You,
He
you,
he
you. I'm asking about you.
yeah, I'm trading like for like I got introduced in 2000. Don't let me lie, man. 2018 I was introduced, maybe 19, 18 or 19 before COVID. 1 year before COVID, I got introduced in it, and I had a very shitty experience. Like I used some multi-level marketing system, you know, like
Yes.
some algorithm who would not lose any trades and stuff. And I used that and I lost money. And then I said I will go there on my own. I went in there with no experience. Then I lost my money. Then I said, okay, I will learn baby pips. I learned baby pip support resistance, bull flag, beer flag, all this type of retail stuff. Then somebody came to me and said, hey, no, this is all bullshit, you have to learn this. Then he showed me how to do liquidity stuff. Then I found ICT. Then I learned ICT 2 years, maybe 1 2 years I traded ICT. Then I found this other guy who said, hey, you know what, ICT is not the end game, you know, there is something better out there. And then I said, are you for real, man? When does this shit even stop? You know, like every time you think you got it, somebody's coming and telling you, nope, nope,
This
nope.
always happens with the market that when you think, oh, I know market like 75%, I know it. And
Yeah,
next
you know,
week
maybe
you
like,
just think,
yeah,
wow, I don't know my
you don't
0%.
like. I studied the whole ICT thing, right? And then this one guy came to me and said, hey,
Yeah.
ICT is good, but there is something better. And I said, I don't believe you. I didn't believe him, right? But he proved me wrong. And then I was a little bit angry because I spent like 1 or 2 years learning ICT and I was a little bit of successful, but then I saw this guy was actually counter trading my trades, right? And I was like, how is this possible? I was like, this guy is on the other side of my trade, and I'm thinking, man, I'm sitting in drawdown, and this guy is profiting from my stop loss. And then I said, okay, you know what? I have to learn it, and it was a hard way, but I think we're coming to the end now. I think Ray is really the end game in this market. I think if you want to learn more than Ray has to offer, you have to go to the institution and learn it from the best trader there. Otherwise, you won't learn it anyway. You won't learn it.
Yeah. This is, I think, this is the process that every trader follow. First learn retail, then ICT, then think that this is the end.
Yeah,
But
yeah, yeah. Most people think ICT is the end, and that's why they think ICT is a god and everything. And I mean, I have to be honest. I like ICT in terms of what he does for the community, right? Because he's active and he's he's not really like, how can I say, posing or something.
yes,
But
actually, he's showing something that there is a way.
he shows you how to be profitable with his concepts, but Ray is showing you how the market is working. Because ICT never teaches you about yield and he's never talking about it. He's not talking about the function. He's not talking about fundamentals. ICT says he never looks at fundamentals. But
Yes.
this is bullshit. You have to look at fundamentals. You have to look at ICT is teaching time of day, but he's not teaching volume. He's not
Actually,
teaching
yes.
which liquidity is good, which liquidity is bad, and
He
his
never
order
thought
flow.
about them. Yes.
Yeah, and his order flow is way different from the real order flow, like from
I,
deltas and
in last post, I asked ICT that you are posting the market makers model in the YouTube new playlist. but you never told about how market makers trade, because you
Yeah.
told me that they trade like one tick trader. So I asked him, and what he said that I teach the interbank perspective. So and there, there is a limit on his comment box. So I leave that. Okay, that's fine. You
Yeah, I
teach
mean,
interbank, well, why I care?
yeah, he's definitely right, because what he did is he's teaching it from an interbank perspective, and this is good because what you have to think about, the commercials are always getting the best price. Sometimes you will get the price the commercial gets, but you won't get the size the commercial gets, because if you compete with the commercial, like if you you can't buy the same low as the commercial with the same lots, because he will get the fill, you won't get the fill. And for example, the desk traders are together. If you remember, I sent you a PDF file where it's illustrated on the 50 retest. This is where the algos and the prop desk traders actually start to engage, and this is what ICT teaches. ICT never teaches you to get the top on in a market maker sell model, but rather wait for the retest when it comes back. So he's not telling you to get the highest high. He's telling you to get the break of the structure, then the retest of the order block or whatever, the 50 line, and then trade down. And this is basically what Ray teaches us, but Ray teaches it from a
But he
institutional
actually
perspective.
trade. But ICT trade in his, when he show up his trades, he trade the low and high when he show executions.
Okay. Yeah. That's what I mean.
Yeah.
This is the lower high is basically the 50 retest. I mean, if you think about it, like I would just share my screen for one more time. Whiteboard. Look, you see my screen, right?
Yes.
Good. The whiteboard. Have to delete it. This is the market maker's sell model. Consolidation, expansion, retest, expansion, retest, high, consolidation. Then this is the market maker sell model now, and then it
Smart
pops
money
down.
reversal.
Yeah, smart money reversal.
Yes.
Then it comes like this again, and then it takes out this low here. So this here, this here, this here, this here, and this here. And basically what you can do is you already know, okay, if this here is a higher hold, right? And
Yes.
you have value like this. You know what to do here. You already know what to do here. You know to buy, and you take your projection from this balance area, like let's say this balance area is a little bit bigger, like this. You take your projection up here, and then you exit. This is what the algo is doing, and this is why the market maker model from ICT is built like this, because from a consolidation there comes a breakout, and if it breaks out, it goes a certain distance, and this distance is mostly the -2.
Yes.
And this is where the algos are starting to be more aggressive with their orders. So they will try to sell 100 lots in here, and the institutions, they will help because they will take profit here and also start to sell. So this makes the reversal more probability. And
Yes.
when you get this low volume retest, what you can see is actually sometimes it pulls back like this, and this is then just a 50 pullback, But
Yes.
in the same thing, you have to have value. Value is the most important thing, because this is what ICT is not teaching you. This is the key to trading, because if value is just like this, right? This is not a market maker sell model anymore. You can't sell this, because if value is kicking to the upside and this is going down, this becomes like, if it goes down like this, takes this liquidity, this is C liquidity. I will just buy this and make an higher high. And this becomes then suddenly a commercial accumulation, like I drew the wrong color now because
I understand.
but you get the point. You get the point. Like this,
Yes.
this sell model is only working if you have value in your favor, and this is basically what Ray is teaching as well. Just a little bit more logical with levels, like which you can refer to. Like if you have this top here, you have this 50, and you see this here. you get this B shape. When you get this B shape, you can be sure price is dropping down. This is a break of structure now. And when it pulls back, a 50 pullback of this range here, for example, it comes like this, see liquidity, boom, it goes down again. And of course, only if values like this.
Yes.
So he's teaching levels. ICT is teaching bias.
Actually,
This is the thing.
teach about the swing trading. Why? Because he said that look at the value in the higher time frame and take your trade in that direction. Don't do the intraday trading. Do the swing trading. Actually, his whole I hear that he tell this thing many times.
Okay.
Don't do the trading. Always do swing trading.
Yeah, you know, this is, yeah, you can agree with it, but me personally, I can't do it, you know. I just, like, for example, I just need some good examples like a smart money reversal, but I don't see them too often because to me, in my eyes, a reversal is a swing high which bring a swing low which brings a swing high. This is for me already a reversal trade, you know. Like if I, for
Okay,
example,
I will talk to you in next session about investing. Look at the
investing.
IRCTC. There is a stock. So how I can enter in that type of stock? If you look that IRCTC is the stock. Suppose if
ETC
I
is a
want
stock.
to what
Are you talking about stop? Do you mean stop or stock?
stock.
Stock.
So investing for the investing. So if I look IRCTC, there is nothing I can find out. It goes into only in one direction. So how I
Okay.
can enter in this type of stocks? I will talk this about this. I will send you that chart.
Okay. Yeah. Okay. Yeah. Do that because I have no experience with stocks whatsoever.
Yeah, you are lucky that you can trade currency. That
Yeah. Yeah. Sure. But I mean, you also can trade commodities, and commodity market is also a good market because it has real supply and demand. You know. So
yes,
this is why the supply and demand levels on oil make so much sense because there is a real supply and demand for oil because people need oil. It's not like you need euros because banks need euros or pounds or yens or something like this. We don't need it. I don't need yens, you know.
and
Why?
money is also making that very fast.
Yeah,
One
exactly.
lot
It's
is
just a
like
profit.
you make a bigger profit. If you go one lot gold in your direction, like last gold crash, I don't know you traded that or not. That is like
Last
big.
gold crash, the big move.
Yeah, that in that day gold down by 3-4%.
No, I didn't trade it, but I was inclined to buy it, but I didn't do it. Unfortunately, I was trying to catch the bottom edge of the trade, but no, I had a gold buy. I had a gold buy this week. I
Not
had a
I'm not talking about this week.
Yeah, I know. You
Some
talk about the big short.
yeah last month I guess.
Yeah. I know which one you mean.
Yeah.
From from 90s to 78s. Like no, from 18s to
And
17.
I was trading a demo account of FPO, and I think that what is happening, why the profit is going like this speed,
Yeah,
and
this
I
is like
think of
you know this is like just huge liquidation, and I mean it happens on low liquidity markets, and gold is in fact a low liquidity market. And I mean, if you think about it logically, how much gold can there potentially be in this world for every single dollar, you know? If you would
yes,
really compare it, it's very a small amount.
very small.
So what they do is they invented this gold spot price, which is just paper gold. So when you buy gold on the market, you just buy paper gold. You don't own the physical stuff, but you own the paper that says, hey, this paper is much this much worth, you know, this paper is this much worth, but you're not actually buying the physical gold. Like, this is the thing. And once the spot price goes away, once there is no spot anymore, the gold prices will just have a huge bull market. And trust me, we will be part in that bull market. I can bet my fingers on it. I can bet my fingers on it that we will get this trade, because it will happen. Gold will always be a bull market, no matter what.
Yes, yeah. I think gold is against the currency.
Yeah, it is against the currency because it's real money. Currency is currency. Money is something that holds value, and gold is a thing that holds value because it doesn't lose value. Currency over time, if you look at the US dollar from the creation of the Federal Reserve, like from 1940 to 2011, it lost 97% of its purchasing power.
And what is the meaning of this news that forex market loses this much, forex market get this much from the forex market profit to
The thing is, it's just for the banks. The banks use the currency market to make profit. So what they do is they just create money out of nothing. They basically the banks steal money from each other. Basically, they lend it for different rates. Like, for example, I lent you $100 at a rate for I lent you, like, for example, you pay me 2% interest, right? $100. You have to give me back $102. But let's say the rate just increased to 6. You have to give me back $4.
Yes.
Where do you get these $4 from?
I don't know.
You don't know, right? So you create these out of thin air and just give it back to me. So now you have you just created $4 out of nothing.
Yes.
So you took debt, and you said, okay, if you go to the government and you say, hey, I need $4 for this and this type of transaction, I will pay you these $4 back in 10 years, maybe. Okay, let's say, just for example, in 10 years, I will pay you back $4.
This is called reverse repo rate. This called reverse repo rate, I think, in the economy world. Yeah. When banks lend from the central bank, like RBI, so RBI give the money to the local banks. This is called reverse repo rate. And what if bank give the money, that is called repo rate. I will, like, I learn some economy. Economy, like,
I know.
101 concepts.
I mean, I understand how money is created. Basically, what the Federal Reserve is doing is the government is going to the Federal Reserve and they're writing a check. They need, let's say, $100 million.
What is the? I don't want to ask so many things. What is this Federal Reserve? Like, my government is having some Federal Reserve. It means it is holding the dollar.
Yeah. This is the funny thing, you know. Like, okay. Man, we're in 3 hours. I can't believe it. Oh, okay. Look. For example, no, all good. I'm just gonna explain you a little bit about it. Okay, the Federal Reserve, right? Yeah. It's a private bank. It has nothing to do with the American government. So think about it. This is a private bank which lends dollars to the US government with interest on it. So this means the government is taking money from the Federal Reserve, which have no backup whatsoever. They just print dollars out of thin air and lend it to the government with interest on it, okay? Yes. So let's say
Federal banks is private banks.
Yeah, all reserve banks are privately owned by JP Morgan, by Goldman Sachs, by the Rothschilds, Rockefellers.
Okay.
It's common. It's you have to read about something. It's called let me Google it for you. I don't know who made it, but I'm definitely sure I will find it. It's an island in Georgia island. No, Georgian island. maybe I will find it. I'm not sure.
Okay,
Okay,
send me the
I
link
found.
later.
Yeah, okay, I will send you the link here.
Yes. I have to go for the lunch also.
Yeah, man, I have to start my cleaning too, man. But I will send you the link. It's very
Yes,
interesting.
we will talk about this again.
Yeah, next time.
Okay,
All right,
thanks.
man. Have a good day, man. And we hear
You
us.
too. You
All
too.
right. Bye bye.
Bye bye.